Great. So welcome you all once again to the Advanced Financial Statement Preparation. In this section, we are going to look at for how to deal with the footnotes, complex footnotes. So we'll start scanning through a lot of questions with their footnotes and look at how to prepare a redraft. Redraft, meaning that the examiner will prepare his financial statement for you, but with a lot of errors and then adjustments need to be passed. That is the section I will look at for today. Let's see our questions. Let's look at our questions. So our questions. So first, I've scanned through a lot of questions. Let me use this particular one. First question that we are going to look at for today is okay, I believe this, we look at it in our first meeting. Yeah. Now let's start from question 2. We are interested in the footnotes, how to treat them. I will actually treat the footnotes, that is all. Okay. So first, we go to the requirement. Prepare the statement of profit and loss for Excel for the year ended 31st March 2014. Immediately mention 31st March 2014, pause, and then look at the year in question. If the year ends at 31st March 2014, where would the year start from? Or the year will start from first of the next day of the previous year. That is all. The next day, that will be the next day, that will be 1st of April, previous year 2013. That is all. Good. So that is it. We are reporting between these years. Let's see. A statement of change in equity for a store for the year ended 1st March 2014. Prepare the statement of financial position for a store and then calculate the basic earnings per share. Good. I mean, this pattern is similar to that of the first one that we looked at it last meeting. And last meeting, this particular question. No, the requirements are very similar. There was earnings per share 2 units for the T. So take a look. Okay, so that's the requirement. Notes. Answers and workings for parts A to C should be presented in the nearest to thousands. Note the financial statements are not required. Okay. Let's go to the footnote one after the other. We're actually going to solve the footnote. Revenue. Note 1. Revenue includes an amount of 20 million for cash sales made through a store's retail outlet during the year on behalf of answers. A store acting as an agent is entitled to a commission of 10% of the selling price of these goods. By 31st March 2014, Extol had remitted to Francis 15 million, that is, of the 20 million sales, and recorded this in the cost of sales. Okay, good. Now, this is IFRS 15 revenue. Good. And this is agent sales. Agent sales. So we are selling on behalf of our principal or someone. The standard does not allow us to include the entire sales in our revenue. So we are the agent. So Extol is acting on agent on behalf of who? Francis. Now the sales, agent sales, and then the remittance, that's the cost of sales, should not be part of Extol's or profit and loss. Why? Because Extol is acting as what? Agent. So you become agent sales. In agent sales, you only record your commission, the 10% commission. That is all. So it's the commission that you need to record as its revenue. Either you add it to other income or you add it to your main revenue. Yeah. Add it to your revenue. That is all. So now let's take hold of his commission, which is 10%. That is all. Any other transaction needs to be reversed. That is all. So let's go. So anytime there's agent sales, tell the examiner that the only amount that the agent can record in his books as revenue is what? To the tune of his commission. That is all. So let's do this. Now, the revenue includes an amount of 20 million, so the entire payment in the revenue. Fine. Meanwhile, the cost of these goods is what? 15 million. The cost of these goods is 15 million. So he has remitted the 15 million to that of Francis and treating it as what? Cost of sales. So we need to reverse all these transactions. So first, this 20 million I have to take off from revenue. Yeah, because it's not my revenue. So take it off. So revenue should go off by 20 million. Second, they've added 15 million to cost of sales. It must also be reversed. So 50 million should be reversed from cost of sales. That is all. Then the last section is you take account of what? Your commission. So in short, 20 million need to be subtracted from the sales revenue. So subtract 20 million from sales revenue. And then 50 million from your cost of sales. Good. If there's any inventory, any inventory need to be reversed. Do not add the inventory to your inventory because the goods are not only your own. That is all. That is all. So in short, find 10% of this sales revenue. So 10%, and this is cash sales. So this 20 need to be reversed. So let's go to the board. Now, it's a cash sales of what? 20 million dollars. And the remittance, remitted 15 million. Okay. Now, what happened is this. This means that when he made a sale, he has added the funds to cash. So in short, we need to take records of his commission. That is all. So let's reverse all these transactions, all these transactions. So first, sales revenue. Sales revenue, I will subtract, bracket, I will subtract 20 million from sales. Again, cost of sales, I will subtract 15 million from cost of sales. That's the first thing that I'll do to reverse what public has been transferred. And don't forget that if you just subtract 20 million from the sales, you'll have a cash component of 5 million. How are you going to treat that? A cash component of 5 million. Okay. So now, number 3, the cash component of what? 3 million. I will do the long approach, and then from there we'll look at the shortcut. That means after your commission, whatever remains, hold it as liability. You are owing the principal. That is all. Because after taking your commission, whatever remains must be given back to who? The principal. That is all. So let's calculate the commission. Let's calculate the commission. So the commission will be 10% times what? Commission will be 10% times the 20 million. So let's assume $20 million, and that will be $2 million. Okay. What is the treatment? Now this one becomes his income. So this add this to the income. If I add this to the income, then it means that it left with 3 million because he has remitted what? 15 million. No, the total amount is what? 20 million. So now last entry, the 4th entry is record a liability. Record a current liability. Call it deferred or owing to that of the principal of what? $3 million. That is all. $3 million. Current liability include a liability of $3 million, and then it will now balance nicely. Good. I don't predict must balance because all the debits must balance, all the credit must balance. Good. Because if you add these two together, commission have a credit balance too. Can liability have a credit balance too? Good. Add them together, get your 5 million. Good. Now you have subtracted 20 million from that of your sales, and then 15 million from that of your cost of sales. Good. You have reversed the entire transaction, and then you record your 2 million as revenue. That is all. 2 million as revenue, and put the 3 million in your current liability as a part that is owing. That's all for this particular note. So let's take notes of that. Let's move on. That means this agent is still owing 3 million, which need to be remitted to the principal. And show that one in the current liability. And don't forget to account for the 2 million in here. Okay, so let's move on to the next footnote. This footnote, like, let's go to note 2. Plant and equipment is depreciated at 12.5, sorry, 12.5 5% per annum on reducing balance basis. All amortization and depreciation of non-current assets charged cost of sales fine. So depreciation charged cost of sales. We will calculate it. On August 1st, 2013. August 1st, 2013, we are reporting when? April 2013, right? So we are reporting April. So 1st of April 2013 up to 31st of March 2014. So 1st of August 2013 will be how many months? That means we started August. We started our financial year April. August will be in somewhere from August 2013 to 31st March 2014. How many years? So let's count. August start. So August. September, October, November, December. So that will be 5 months plus the 3 months to 2014, which is 8 months. That's all. Okay. If you need to prove it anything, it might be on 8-month basis. Let's move on. Exxon made a fully subscribed right issue of equity share capital based on 2 new shares at 60 cents each for every 5 shares held. The market price of restored shares before the issue was $1.02 each. The issue has been fully recorded in the trial balance figures. Thank God. Fully recorded. Yes, so you need this to calculate the right issue and then finally to calculate the earnings per share. So this is for the earnings per share. So the earnings per share prorate the number of shares that came in at full market price and using 8 months out of 12. So first, you know the steps. Calculate your total proceeds, calculate your debt, get the amount that came in or proportion of the shares that came in at full market price. Consider the right issue have 2 features. Some of the shares were for free, some of the shares were at full market price. So this note will not affect your final accounts. No, right issue does not affect your final account. So let's go to note 4. Note 4. On April 1st, 2013, a stock issued 5% 50 million convertible loan notes at par. Interest is payable annually in arrears on the 1st March each year. Fine. Now, 1st April, that's the beginning of the year. Thank God, don't have anything to control it. Fine. The loan note is redeemable at par or convertible into equity shares at the option of the loan note holders on the 1st March 2016. The interest on equivalent loan notes without the conversion right will be 8%. Now watch this footnote carefully. Yes, watch this footnote carefully. One of the recent exam questions, this footnote was captured in, and we'll look at it right after this. So the interest rate on equivalent loan notes without the conversion right will be 8% per annum. The present values of $1 receivable at the end of each year, based on a discount rate of 5%, 8%, are in here. This is what we call compound instrument. How to treat compound instruments. So for this particular note, I'll actually solve it. How to go by compound instruments. Now, for compound instruments, we need to just at the inception determine the equity option and then the liability portion. That is all. So that is note 4. Tell the examiner first convertible loan stock or loan note. First of all, we need to break this loan into two. When you say convertible loan stock, this is a compound financial instrument, meaning that it's an asset to one party, but it could be equity or equity and liability to the other party. That is a compound instrument. It's an asset to one party, equity and liability to the other party. Good. And in fact, in short, they come with the name convertible. So anywhere you see the word convertible, it's a compound instrument. Convertible, compound instrument. Meaning that the holder have the right to convert these debts, into what? Into equity when it matures. That is all. How do you treat this in a book? First step, third examiner. This it comprises of equity and liability. So just break this into two. Find the equity component and find the liability component and treat them separately. Because this have what we call recognition criteria. This does not have any recognition criteria. That is all. I don't go to detail. So how do you do that? Let's go straight. So third examiner, equity portion, calculation of what? The equity portion. Align it. First of all, present it in a nice table. Please see this again. There are other versions of the presentation. I'll be starting to show them for you. Let's do something in here. So first, third examiner. Mr. Examiner, I need my year. I need my cash flow. I need my discount factor. Then I need my present value. Now, how many years? So let's go to the question and look out for this item. The years are I can see 3 years in here. The loan note is reasonable about not going to this year, so not to that. On 31st March 2016, today, we issued on 1st April 2013. So from 2013 to 2016, how many years? 3 solid years. Fine. Good. So that is it. Then the cash flow. In fact, the cash flow is the coupon rate, the 5%, on the face value or the par value or the nominal value, which is 50 million. That is all. Good. So that's the cash flow. The interest that we are going to pay on this debt is 5%. The coupon rate normally is the least or the one that which is a bit lower. The effective interest rate or the discount factor is the one that is a bit high. That one is on the market value. That one's a fair value. Good. And that's the internal rate of return. So the cash flow will be 5% on the 50, the face value. We are done. Then the discount factors pick the 8%. We use the nominal interest rate to find for the cash flow and use the effective rate to discount the cash flow. That is all. So let's go. So year 1, year 2, and year 3. The cash flow, it will be the same throughout, which will be, let's calculate 5% times 50 million. Let's rate 3 zeros. Let's say we should work in thousands. We are working in dollars. So thousands of dollars. So 5% times 50 million. That should give us something like, let me do it somewhere here, 5% times $50,000 2,500. So year one should be 2,500, 2,500. Now, when we go to the final year, two things will happen. Let me put the workings here. So final year, bracket here, 3, is equal to the cash flow plus the redemption value. Redemption value. So here the cash flow is 2,500 plus the redemption value is 50,000. That's the par value. We're informed that it will be given at par. So that's 52,000. So 52,500. That is all. Fine for your discount factors. Good. What is your discount factors? Let's pick them. If it's not in the question, kindly calculate your own discount factor. It's 8%. Choose the effective interest rate. It's 8%. Kindly calculate it by yourself. It's not given to you. If it's given to you, why not? Just pick it. And don't pick the 5% one, no. So 0.93, 0.86, and 0.79. So 0.93, 0.86, and 0.79. Let me confirm again. I suspect issue in this. Okay, so all of them are correct. Now let's find for the present value. Let's multiply. Sure. To get the present value, we need to multiply them. So 2,500 by that of 0.93. So 2,325. Good. Let me do it well. So 2,325. What about the second year? 2,150. Then finally, get something like last year, 41,475. 41,475. Can you put all together? The answer is called the total present value. We call it the liability portion. So this is the liability portion. The total 45,950. 45,950. This is the liability portion. Now, you leave a space. Leave a space. And write a total proceeds. Total proceeds. The actual amount that you receive. Leave a space here and write your total proceeds. Yeah, the total proceeds is what? 50,000. That's the face value. The actual money that you receive. In some situations, the total proceeds is equal to the par value, so much, less any discount, so much, and less what? Transaction cost, TC. This is the proceed. But this question, we don't have discount, we don't have transaction cost, so it's still the same. Now, can you find a difference between this and this? That becomes the equity component or the equity option. Can you tell the examiner it is equity option? Equity option. That's 40-50. 40-50. That's the equity portion. So we've been able to break this total convertible liability into two. Liability and equity. Now, the equity portion, you don't need to adjust it again straight to the financial position as what? Equity. Please and please again, when you go, add the option to it. It's an option, it's not a final equity. Add option to it. It is not a final equity. Why? Because the guy have right to convert it. He has not exercised that right now until the maturity date. He will probably select one, whether to redeem or convert. Fine. That is all. And proceed to account for the liability portion. So this is the first step, step 1. Step 2, let's go look out for the movement in what? In liability. So I'm going to clear this section and look for movement liability. So over here, the only figures that we need, we are going to use this figure. This one goes to the balance sheet. So go to the balance sheet and the equity. Let me assume that these are balance sheets. And the equity like this are stated capital. Sorry? Sorry, it's not coming to them. So stated capital. So much. I come here. Equity option. So much. This figure 40, 50. Now we'll call the other equity items to it. So take note of the treatment. We are done. Let me go to the liability section and quickly finish it up. Liability is 45,950. Calculate what you call workings number 2. Calculate the movement in liability. So still under this, the second section is the first one. Third examiner, movement in what? Liability. Start. Now I start with year. Year 1, year 2, year 3. In this question, please and please again, you are not interested in the last 2 years, so don't add the last year to it. The movement liability. This is a publication, not like testing of the theory. That's the standards itself. No, this is a practical question. So third examiner, the open balance. Third examiner, the effective interest rate, which is at 8%. Third examiner, the nominal rate. Nominal rate, which is at what? Which is at 5%. Third examiner, the closing balance, that is all. So let's see. And you need only the first year, just the first year. That is all. So I'm saying that this is not that plenty. The only challenge is how to break and get the liability section. What is the open balance of the liability? That is a liability component. That is the liability component. It's a 45,950. So 45,950. Find 8% on it. What do you get? Then you move on. Good. So 8% on the value. So 3676. 3676. Don't forget you're working in thousands of dollars. In that order, but continue all. Then you go to the nominal. The nominal value becomes still 5% on the face value, not on this. 5% on the face value. You are still getting what? 2,500. Put it in brackets. If you want to continue for the years, it will be 2,500, but it's not. You are not interested in. You only report in the first year. Check where the year in question, like that. If assume that we are reporting in this period, then you need this year. Take note, we are just at the first year. What's the closing balance? Let's look at the closing balance. With this one, add the effective interest rate to it, less the 2,500 to give you this. Now, financial liability, all financial liability should be measured at what? At amortized cost, unless otherwise stated. Good. So this is the amortized cost. The difference between these two, they are the amortized cost. And you add it to this, get 47,126. So 47,126,000. Okay. So it means that our end here, you can continue to finish fast. When you go to your P&L, for this particular year, the finance charge should be what? 3676. First, you have to pick up 4. When you go to your financial position, the final figure for the convertible loan notes, right? Convertible loan notes. So you go and pick what? The 47,126. That is all. They are done. Now you check whether they've actually paid this interest. You will see it in the question. Let's go to the question. The trial balance. If they've actually paid the interest of 2,500. Okay, so loan notes, interest, and dividend paid. Okay, so note 4 and note 5. That means you've added a certain item to a fine. Let's go down and see something. So you paid. That's very good. So now note, we are done with this particular note. That is all. So in summary, note like this, if it's convertible loan notes, you need the following items. First, equity option. Equity option. First, number 2, you need your finance cost. Number 3, you need your closing balance. The balance carried down. That is all for you to define. Now let's go to the next footnote to finish this. The next footnote, an equity dividend of 4 cents per share was paid on 30th May 2013. And after the right issue, a further dividend of 2 cents per share was paid on 30th November. Yeah, this is a very nice one. Now, to get a total dividend, you need to do some calculation. But here you can probably trick the examiner, although you pick through the examiner. This is so clear. The interest, if you go to the footnote, they've combined the dividend and the interest together. And we know it to be 2,500 from the previous footnote. The interest that they paid, they'll pay this 2,500. So if you go to the trial balance and they've combined the interest to any other item, then you can find the difference as the dividend. So this is 13,500, right? So this is 13,500. So that means if the dividend, if the interest is 2,500, then the remainder becomes what? Becomes the dividend. That is all. So the simplest way to solve or to look for the dividend is to tell the examiner, I'll take 13,380 and then take the 2,500 from it to give us the answer. So the total amount is 13,380. The last interest paid 2,500. So therefore, what is the total dividend paid? The total dividend paid. Good. If you take 2,500 from what? 13,380. Even though I'll actually solve it. Let's cover the dividend, but get the answer for us. But you can also prove this or that calculation. Something like 10,880. So let's confirm this. So let's calculate the dividend. This one becomes the dividend paid. Smartest way. Smartest way to pay the dividend. Okay. Now to calculate the dividend, first of all, there's a dividend paid before and after the rights issue. So there are 2 dividends paid. Let's calculate them and sum them together. According to the footnote, an equity dividend of 4 cents per share was paid on 30th May 2013. Okay, so 4 cents. And then after the right issue, they pay another 2 cents. Now, you know that before the right issue, the number of shares was less. After the right issue, the number of shares becomes more. So take note. So, first, I'll pick them one after the other. The May dividend. In fact, we need a number of shares. Here you can just draw a line table for the examiner. That is your calculation. So the dividend payment, only 2. This one, the May payment, we need a number of shares. I'll come and put it here. We need the amount paid, dividend per share. That's $4. So $4 somewhere 0.04. And the one they pay in November after the right issue. That one I can get these details. Yes, you can get it. You can put them there. This is in dollars. This one also is in dollars. Thousands of dollars. Let's see. Very smartest way to calculate this. Now let's go and pick those figures together. Now, what will be the total number of shares? Let's say equity shares 25 cents each. So if the shares, the total value is 56,000, then if I divide 56,000 by 25 cents, I should probably arrive at what the number of shares. Good. Okay, so it means that the number of shares after the right issue will be 56,000 divided by this 25 cents. So let's see something in here. The number of shares after the examiner is bracket 56,000 divided by 0.25. And let's see. So that will give us 224,000 shares. Let's see. 224,000 shares. So now these 224,000 shares, the dividend per share was 0.02. That is 2 cents. So what will be the total value? What will be the total dividend paid at the end? You do the easiest one. Now what's left in this one? I want to calculate it. What will be the total value? So 4,480. So this 4,480. Now we need to get the number of shares that the company have before the right issue. This is the number of shares after the right issue. So what's the number of shares before? So let's go and get the number of shares before the right issue. Let's do something here. Now, to get this, it's a bit straightforward. A bit straightforward. Can we use the equity shares? Now, when you get there, let's pick the right issue. The right issue was based on 2 new shares for every 5. So now, let's form an equation. Let X represent the existing shares, the one we are looking for, before the right issue, the number of shares that they have. Okay. Now, anytime there's a right issue, the new one, we multiply the existing shares by the new shares over the existing shares. That is all. To give us the new shares. We are done. So the mathematicians, let's start the game. We know the new shares to be 2, existing shares to be 5, times the total existing shares to give us the new shares. So this times 2 out of 5. This one alone will just give us the number of shares that we had, or number of shares that came in the form of what? Right. Now, plus the existing shares is now giving us 224,000 shares. Find X. Start quick, mathematicians. You can just use your calculator to do this. Yes. And then when you are done, I will give you a shortcut. This is a long approach that I will give you a shortcut to look for this. So tell me, I'll give you a shortcut to solve for this. Okay. We had a part from the question. Let's see something in the question. As you are solving, they said the right issue of every share capital based on 2 new shares at 60 cents each for every 5 shares held. So there's a shares. The right should be 5 before you qualify for the new shares. That is all. It will be 2 out of 5. That is the ratio. Okay. Can I divide 2 out of 5 for us? So in short, 2 divided by 5. Now, this will give us 0.4. Agreed. This divided by the 0.4. 0.4 times x, that's 0.4x plus x. So that will give us 1.4x is equal to 224,000. Find 4x. So 224,000 divided by 1.4. That is all. That will give us the x. That will give us the new shares that came in. Actually, that will give us the new shares that came in. So let's do something here. So 224,000. So 224,000. So 224, 123 divided by 1.4. That is 160,000 shares. Okay. So now x is equal to 160,000. That is all. So 160,000. That means the existing shares is 160,000 shares. That is all. So x, which represent the existing shares, is now equal to 160,000 shares. So that meaning here is 160,000 shares. Wow, that's so interesting. Now let me give you a shortcut to get this. The shortcut to get this. Don't worry yourself. This is a shortcut. That examiner, what's the right issue ratio? Okay, this is 2 out of 5, right? Okay, find the percentage. Just multiply by 100. This is 40%. Okay. So it means that new shares have increased by 40%. So that is all. Okay. So that means this figure represents 140%. Agreed. Because that's increased by what? 40%. So in short, that examiner, if let's do some small calculation here, if this figure represents what? 140%, because it has increased by what? 40%. So if 140% is equal to 224,000, what am I looking for? I'm looking for the 100%. So therefore, 100%, the original one will be what? I don't know. That's all it. So in short, after finding this percentage, don't worry yourself. Just bring what you want. I need 100. The shortcut is this. Always start from 100. Tell the examiner, this 100 plus the 40 that you had here, make it 140. That is all. This answer times the existing, times the new one, 224,000. This answer should be what? 160,000. That is all. We are done. So that is the shortcut to get this. Now let's multiply by 0.04 and let's get the value. So times 0.04 times 0.4. That should give us 6,400. So this is $6,400. Let's put the two together. Let's put the two together so that we can get a total the two. So this and this will give us 10,880. And like I said, all this is just a waste of time in exams. Doing all this is just a waste of time because you could have just subtracted the interest from the total figure and get the same 10,880. That is all. And move fast and finish fast. When you are done, come and provide this working for us. However, in some situation, if I should set the question this way, then in some situation, no matter what, you need this. Let me walk you through how would that one be. That one, they will not add this to the figure that you can easily determine. They rather add it to administrative expenses. They will tell you that, oh, the dividend has been added to admin expenses. You know, admin expenses, a lot of stuff going in there. You cannot easily strike difference between the other one and the entire admin to look for the dividend. No, it can't happen. So that one have to go through all this. So the secret is that if you go and they've added dividend to admin, that means you have to go through this process and calculate it again. Good. Now, after calculating, what's the accounting treatment? So in short, just take the dividend to your retained earnings. Just subtract it from the retained earnings. That is all. It ends there. Does not go anywhere again. Because on the trial balance, all the items on the trial balance should be treated just once. This item is not in the footnotes, it's on the trial balance. Like I said, items on the trial balance are treated once. It's in the 13,380. It's in here. The footnote over there was just explaining how they got that figure. It's not giving us any new item. They said equity dividend of this was paid. It was just telling us the combination, the total. That is all. So we are done with the note 5. Let's go to note 6 to end the game. The balance on current tax represents under and over tax liability for the year ended March 2013. Let's go and see the balance. If it's on the debit side, it's meaning it's an expense, which means there's an under. If it is at the credit side, which is again a plus to you, which is a what? Over. So that's all. If you see current year tax like this, balance represent under or over tax. And that means an additional expense due should be at the debit side. Over means it's a gain which needs to be subtracted from your expenses. And that should be at the credit side. So this is what under. So go and add. When you start tax, issue of tax, you need 3 items. When issue of tax comes in, you need 3 items. Summary, CU and what? D. That is all. So current year tax here is under. Under of what? The figure that we have, we put it in. And then this is a current year, this is a deferred tax. Then you are done with the game. I believe issue of deferred tax and current tax is not a big deal. If it is, don't worry. Go back to the IAS 12 lecture material, take it, and then you are fine. Let's continue. A provision of 28 million is required for current tax for the year ended 31st March 2014 at this date. So the current year provision is for 28 million. Fine. At this date, the deferred tax liability was assessed to be 8.3. This is the closing balance of the deferred tax liability. Meanwhile, we're supposed to count by ourselves. We'll do a separate working again for deferred tax. So here is $28,000. And that was, I think, 3,200. You add. Deferred tax, you provide a separate workings. You can do it. Check the opening balance from the trial balance. Reported in dollars. Thousands of dollars. Check the opening balance of the deferred tax from the trial balance. So from the trial balance, deferred tax is like the last item. That's 4,600. Good. Closing balance is 8,300 given to us in the last footnote. So 4,683 for 4,600. Leave a space and then write here closing balance. Closing balance is 8,300. Okay. So the movement, the difference should be in here. That's all. This one goes to the financial position as a non-current liability. This one goes to the financial position as what? Current liability. And then the total figure here, can you find the difference for me? 3,700. Thank you. So this 3,700 is the deferred tax. It has increased. So therefore, you add. If you add 28 plus this, so that's 6,900. That's 34,900, right? Yes, so 34,900 the total. This is the deferred tax. Deferred tax. So for this question, in fact, we've actually solved it. This is the total tax, income tax liability. Income tax expense. And this one goes to P&L. That is all. So in tax, 3 items. What will go to P&L as income tax expense is this. What goes to the balance sheet as current liability is this. This one goes there as non-current liability. The rest will not go anywhere again. For them, preservatives. Well, they are the one that help us to probably get what we want. And I'm done with this particular question. So once that's coming through, you should do it. The rest, I will explain them how to solve them. I'll scan through a few of them. Mobi. Okay. Now, before I go to Mobi, and balance, is there any other item in it that will cause an issue? Let's scan the balance and see. Revenue, there would revenue, cost of sales, no. Distribution cost, you know where to go. Admin, you know where to go. This one is no note affecting it. No note interest and dividend paid. There with it. Bank interest, finance cost. So that means in this question, if I should end here, the finance costs are 2. The one that we had, which is the 3676 plus the 2000 plus the bank interest of 900. Don't forget. 20 lease property at cost. They say depreciation is some reducing balance method. So you calculate your depreciation. Plant and equipment, still depreciation, reducing balance. Lease property, still depreciation, reducing balance. Fine. Plant and equipment, accumulated depreciation, all of them are there. So you need to subtract before charging the depreciation. Event, reduce the closing event, fixed receivable bank. Check the bank very well. Very stubborn game. This one is a bit tricky because the bank is a bank overdraft. So the credit side. Take note of that. Share premium is part of what? Part of equity item. Retain earnings, 5% convertible note at this particular pattern. And then we fully solve this question. For Mobi, I'll just explain how the notes will be treated. And for Mobi, I'll go to Redraft and then scan through one after question Redraft. Okay, Mobi. You look for Mobi. So the balance on the note one. Let's go to the requirement first and look at for the requirement. Prepare statement of profit or loss and other comprehensive income. Normally, when you see other comprehensive income attached to profit, that means there's revaluation in the question. For the year and the 30th September 2013, prepare financial position. Note, a statement of change of this and the note financial statement are not required. Okay. That is all. So this one I'm just scanning through it. I might not be able to solve it and so I like it over the time. I'll explain how it might be treated. Now, note one says that the balance on the construction contract is made up of the following terms: cost incurred to date 14 million, value of contract bill, that's work satisfied 10 million. The contract commenced on October 1st, 2012. What's the year in question? Year in question 30th September. So if year in question 30th September, the financial year probably starts from where? That's 1st October, right? 2012. Fine. That's good news. Okay, so that is that. So we have been account for 30th September. So our financial year starts at 1st October. That means this contract commenced exactly the beginning of the financial year. That's good news. And it's for a fixed price of $25 million. The cost to complete the contract at September 30th September 2023 is $6 million. Public policy is to accrue the profit on construction on base of stage of work completion, given by work satisfied over the percentage as a percentage of the total contract price. So just calculate the percentage complete or percentage satisfied. A work satisfied is 10 million. Divide the 10 million out of 25 million to tell you the total work. The total work. So just calculate 10 million over 25 million. So let's see something in here. So 10 divided. So that should give us around 40%, because 100 divided by 25 give us 4. 4 by 10 give us 40. So that's 40%. So meaning if they have satisfied 40%, so that means you need to take revenue 40%, cost 40% of it. And then that is, to take the revenue 40%, so 40% of the revenue, the contract revenue, and then 40% of the cost. And then that is how put it in. When you are done, can you calculate the amount due to and due from? That one, you pick your profits, add it to your cost incurred to date, and then find the difference between that one and the contract value, which is at IFRS 15, basically. That's how you're going to look at for. Okay. When you go to note 2, Mobi decided to revalue its land and building for the first time on October 2012. A qualified value was determined revalued, so a relevant revalued amount is 16 million for the land, 38.4 million for that of the building. The buildings remain live at the date of valuation is 16 million. Now, when you go to revaluation, anywhere is revaluation. Let me give you a shortcut to deal with revaluation. And later steps to deal with revaluation. Anytime there's revaluation in the question. just ask yourself, when was the valuation performed? Is that at the start or at the end? The first determine when the valuation took place, when exactly, when at the start or at the end. That is all. Step 2, immediately calculate your depreciation. Step 3, depreciation slash your carrying amount. First, step 3, you now calculate your let me calculate your carrying amount at the date of revaluation. Finally, step 4, you calculate your revaluation gain or loss. What's the difference between the revalued amount and step 3? That is all. So I use this question as a test case to provide this. So as when I read after you put them in small, the time you realize we are done. Now, more decided to revalue to land and buildings for the first time on 1st October 2012. That means the valuation took place right at the start of the year, at the inception, because we are reporting for 30 September 2013. So the year started from where? 1st October 2012. Okay. So what happened is this is at the start of the year. Okay, so it's at the start. Now, take note of this normal line. If it's at the start, meaning the depreciation should be based on the revalued amount. This is the meaning. Right at the start of the year, the asset value was changed. So that means that value will be the one that will travel to. So depreciation should be based on what the revalued amount. If valuation probably took place at the end, then you only change the revalued amount just at the end of the year. So that means that value was not consistent. So that one depreciation was based on the original value. Based on the original value. That is all. So in short, the depreciation calculation, any asset that you raise during the year, the calculation of depreciation depends on when the valuation took place. If the valuation is at the start, can you use the revalued amount? If valuation is at the end, can you use the cost? Depreciation must be based on the cost, original cost. It's in the trial balance. Already this figure is in the trial balance. This one is the footnote always. That is all. So if you know these shortcuts, so after the examiner is mentioning it, you just be picking it. And thank God this question is at the start. What is at the middle? Now one half at the start, half on the revalued amount. So take note. A qualified value will determine a relevant value to be determined. Okay. The land is what relevant value, revalued amount to be 60 million for land, 38 of 4 for building. The building remained live at the date of valuation for 16 years. That means we can look for the depreciation, right? So that will be the building. We don't depreciate land. So the building 38.4 divided by the 16 years. That is all. That's the depreciation. Because this is the revalued amount. Because the valuation took place at the start of the use at the start. So the depreciation will be 38.4 million. So 38,400 divided by 16 years. That is all. Carrying amount at the date of valuation. Now, if the valuation took place at the start, you are looking for the carrying amount at the start. What's the carrying amount here? That one is equal to, it also depends on whether the valuation took place at the start or at the end. That is all. So here the depreciation for the building happened to be 2,400. Perfect, I like that. So 2,400. We will call that new depreciation. We'll call that new depreciation. Good. Now let's go to the current amount. We are looking for current amount at the date of what? Valuation. We are looking for the current amount at the date of valuation. Now the current amount at the date of valuation will be, it should be the original cost in the trial balance. Original cost in the trial balance minus the accumulated depreciation in the trial balance, because I'm looking for it as this. If I'm looking for it here, that is why I need to add the depreciation charge for the year to it. That is all. Okay. Let's see something. But it seems like I'm writing plenty on the board. So in short, if I'm looking for current amount over here, I just have to take the cost in the trial balance, let the depreciation in the trial balance. That is all done to give me the current amount. Basically, the other side is not coming clear. Okay, so let's quickly go to the trial balance and find it. The trial balance, the building value happens to be building value. The building is 10,000. Land and building. Where's the land? This is the accumulated depreciation. Land and building should be somewhere here. This land and building 60,000. The land is 12 million, building is 48. I did this one for those who want to pick the 48 and then depreciate it. So the cost is 60,000 less accumulated depreciation of 10,000. The current amount is 50. The current amount is 50 at the date of valuation. That is all 50,000. Have you seen? Very short. You are done. Now, calculate the revaluation gain or loss. Only two figures. According to IAS 16, how do you determine revaluation gain or loss? That's online. According to IAS 16, determine revaluation gain, two items. Bring the revalued amount and then bring the current amount at the date of valuation. That is all. So go to this note. What is the revalued amount at the date of valuation? The revalued amount is in the trial balance. Sorry, it's in the footnote. Can I sum them together? Land and building 38.4 plus 16. So 40, 44. So that's 54,400, right? If you put 38 and 16 together, I'll get something like $54,400. Okay. Current amount here is 50,000. I had current amount of 50. When I take it off, there's revaluation gain of what? 14,000 Ghana cedis. That is all. We are done. This gain immediately, what's the gain? It must go to where? OCI, accounting treatment. The gain should be reflected the OCI. This is revaluation gain. Basically. Now let's wrap up with this. Okay, I like this question. But there's something in there. They're saying that Mobi does not make a transfer from revaluation reserve to retained earnings in respect of the realization of the revaluation surplus. Okay, does not transfer. What if Mobi transfers? If Mobi transfers, it means that we need to calculate what we call excess depreciation. And that one I'll leave it for now. We did that under the ICT section. And that one that don't require it here, so I don't need to talk about it. That one, effect tax applicable to revaluation surplus at what? 25%. That means there's a deferred tax against the revaluation. So all what you have to do is wherever the gain will go, let the deferred tax follow it. So this is deferred tax on revaluation. There's a revaluation gain of what? 14,000. No, she give us 14,400. Went online. 54 minus 50. 14,400. Okay. Now, it means that if you go to your P&L, we're going to assume that this is our P&L. This is our P&L and other comprehensive income. It's how it says revenue up to profit after tax. That is the actual P&L. From sales revenue to profit after tax, the actual P&L. Then you now move on to, let's say, OCI, other comprehensive income. You wrote here revaluation gain. The gain is 14,400. That is under workings number something. Okay, fine. You've seen it. When there's a deferred tax, please, wherever the gain is going, let the deferred tax follow him. Write here deferred tax. Take your calculator, open a bracket. They say 25% times the 14,400. Close it. That is all. We are done. The 125% of 14,500, that's 3,600. Bring it here, subtract it, and that's the net. So at the end of the day, your profit after tax plus all this will be what you call total comprehensive income. Total comprehensive income. Or you can just net this one and put it somewhere in there before you go in further for their total. So basically, this is how you solve the revaluation for this particular question. So if you are solving it, that is all for the note 2. The trader plan, the lease plan was acquired on 1st October 2000 under the 5-year finance lease, which has an implicit interest rate of 10% per annum. The rentals are 9.2 million per annum, payable on 30th September each year. This is in arrears. Okay, so lease, that is IFRS 16. How do you treat it? However, this question was set under the era of IAS 17. So there will be some little transfer here. Now, check the lease. It was leased on 1st October 2000, and that means this examiner. This is not the beginning of the financial year. That means the lease is what? 2 years old. Now, 2 years old. So that means we need to start the calculation in 2 years. So I think I have to do that one again. Please. First of all, calculate the present value of the minimum lease payments. Calculate the present value of the minimum lease payments. The interest rate is 10%. Okay, so the cumulative discount factor will be 3.79. 3.791. Okay. So we will do that. Look at your trial balance. Look for the lease payment or the list. So lease planned at initial carrying amount for 2. So work it out how they got this lease plan, this 35,000. And then the rental paid on 30 September. So the 9,200 they paid is fine. Let's see how they got that value, that 35,000. Now that 35,000, they had it through depreciation. It was depreciated on that of over 5-year period. That is all. That was the depreciation, that 35,000. However, according to IFRS 15, we are not going to use the 35,000. That 35,000, the initial carrying value, that's the fair value at the date of the acquisition. The IFRS 16, leases, requires all leases to be carried at cost and inception. And that cost is made up of what, as you saw yesterday, the present value of the minimum lease payments plus any direct cost, less what, any lease incentives, plus dismantle cost, that's all. So I'll use the IFRS 16 to look and calculate for this. Okay, so they've even performed the calculation in here to tell us the financial lease obligation as of 1st October 2012. They have prepared the calculation to show that. But let's see, if you find the present value and it's not equal to 35, then that means you need to do the calculation again. We perform the calculation. Okay, so let's see the list. I'll just explain it and then move around it. So first of all, to get a cost of rights of use. Now we don't use fair value again, so you like the right of use, which is equal to the present value of the lease payment. Lease payment. Open a bracket. Discount factor is 10%. Find the identity factor for 10%. Use this approach. 1 minus bracket 1.1 to the power minus 5. It's in arrears, right? Okay, so in fact, I can even take this for 1 summit. Like this. All divided by .1, 0.1. If you solve this one, it should give us something like 3.791 times the cash to 9,200. So let's multiply this. If we multiply this, it should, the answer that you get, can use this one to calculate for the lease obligation. So use that to calculate for the lease obligation. That'll be 3.791 times 9,200. That's 34,877. Perfect, which is not equal to 35,000. In the IAS 17, normally we use the fair value of the asset. So, but with the new standard, the IFRS 16, we are interested in the list PV of the list family. So 34,877. Can we use this one as a liability at the start, at the same time as the asset value? So this depreciation is based on this, not the 35,000 stated there. Take note. But if you are solving this question under IAS 17, then we could use the 35,000. Under IAS 17, we will maintain the 35,000 and move on. But the new era say no, we should use the present value. Okay. So can we use the present value to calculate it? For lease, but we solve a lot of examples. So even if I leave you here for lease, you'll be fine. If not, and go through all the lease videos. We have a lot of questions. So far, we solved about 3 different questions in all the lecture material. And we are here to give more. Can we take notes? So I'm down the list. Find the non-current liability portion and current liability in that. Okay. Now the next note says that all plants and equipment is depreciated 12.5% using reduced balance method. No depreciation has yet been charged on any non-current assets for the year ended 30 September. All depreciation is charged for cost of sales. So don't forget to charge the depreciation cost of sales. Now depreciation this asset is 34,877 divided by 5 years. That's all. That's for the list. Let's go to note 3. Now, on October 1st, 2012, Mobi received a renewal quote of $400,000 from a company's property insurance. The directors were surprised at how much it had increased and believed it would be less expensive for the company to self-insure. Accordingly, they charged $400,000 to administrative expenses and credited the same amount to the insurance provision. During the year, the company insured $450,000 of this expense relating to the previously insured property damage, which it has debited to the provision. Now, what happened is this. Here, they requested for some insurance facility, and an insurance company quoted $400,000, like for their property. Now, the company or the director said, no, this amount quoted by the insurance firm or the company is too much. So now let's provide our own insurance facility. That is all. So the company set up their own insurance facility. But funny enough, they placed the same amount quoted by the insurance company. Have you seen? So it's like this. You went to the insurance company to insure your property for you. And this insurance company quoted $400,000. So what? As you give you $400,000, no, this money is too much. In fact, let us set our own insurance cover. So they set up a fund to insure their property. And then funny enough, in fact, they placed the same $400,000 that they said is too much in that account. So they set a provision towards it. Now let's see what happened. Now, at the end of the first year, or during the year, the company insured $250,000 of expenses relating to the previously insured property damages. That means $450,000 has been released from the provision, so they have debited it to the provision. Let's go to the financial position. You have to see 150,000 on the trial balance, talking about provision. Insurance provision, that is 150,000, which is after they have taken off the 250,000. Now, in simplest quotes, that 250 is coming from previous year, not current year. Now, this provision was set for the current year. So, in short, that calculation they done is correct. But according to IAS 8, it is not true. Good. So this is coming from the previous years. So this should be charged against the retained earnings. So in short, that 250 should be charged towards retained earnings, not the expense, not this year's expense. So you go to admin and reverse that 250 from there and just go to retained earnings and key in your 250 there. Rather subtract the impact that the net answer be the same. Like it will not affect, it will not have any impact. Because you are subtracting from admin and subtracting from where retained earnings. So it will not have any impact. And finally, you take the provision, the balance of the provision to your liabilities, and that is all. So I only touch on those that are very a bit, how do you call it? A bit technical. Those are straightforward. Let's start to explain. Note 4 stated clearly that a provision for income tax for the year ended 30 September 2013 of 3.4 million is required as the current year tax. And then the balance on the current tax represents an over as a common practice. And then at 30 September 2013, the tax base for mobile net asset was 54 million, less than the carrying amount. So that's the temporary difference. The tax rate is 25, just multiplied by 25 to 24 million by 25%. And that becomes the closing balance of the deferred tax. Can we compare this to the opening balance, and then you are done. The last footnote states that the 40 million loan note was issued at par on 1st October 2012. No interest will be paid on the loan. However, it will redeem on 30th September for this, which gives an effective finance cost of 10%. This is the par or the nominal interest rate is what? 0. Yes, it happened. The face value could be 0, but the effective interest rate is never 0. No. So all what you have to do is don't forget to calculate the movement liability. This is a bit straightforward, but there's some technical issues. So let me do the calculation for you. If you check the trial balance in here, you will not see any interest. You only see the loan notes of 40,000. Let's go to the board and perform some few illustrations in here. Now, what happened is this. Here we need the movement in liability. This is a financial liability which must be carried at what? Amortized cost. So when you're doing your working of movement in liability, this is how we have to do it. Normally we start by year. Open balance. Effective interest rate. The nominal rate. Closing balance. Okay. Now, thank God, year 1, year 2, year 3. Open balance is 40,000. Effective interest rate is 10%. This one is 0%. So 10% of open balance is 4,000, right? This one is what? Cash. So here you add and subtract this. You are subtracting that. So it will be 44,000. That is all. So it tells me that in your P&L, the finance cost should be what? 4,000. Your closing balance is 44,000. It ends there. You only need the first year. You don't need all the years, please. Just the first year. That is all. So you can even change the format. You can change the presentation to be like this. Loan notes. First of all, we tell the examiner. Liability at start. So liability at start 40,000. Effective interest rate. Tell the examiner. Effective interest in bracket. That's the finance cost, which should be the 10% on the liability at start times 40,000. You get 4,000. Tell the examiner. Less what? Less nominal rate or nominal interest. Here is 0. I'm doing 8. Finally, get a closing balance. That's 44,000. That is all. So you can change the format to be like this instead of using a table. Normally, if you're supposed to do all, that's why you need a table. And that note, I'm moving. I'll start with the redraft quickly. The rest, the drafts you can scan through. Let me go to the redraft. In the redraft section, They will prepare the financial statement for you with a lot of errors, and then a lot of stuffs not getting in. So I'll quickly go in and look for redraft, and then we scan to redraft first thing for you to see how they're going to prepare the redraft. So to redraft first thing. Don't stop with the scanning. These questions are over 20 questions, so let me scan all of them. You can scan. So let's go to redraft section. Good. So this is a typical example of what redraft section. Question 7. Sana Limited is a listed company on Ghana Stock Exchange. The assistant accountant has prepared a draft statement of financial position of the company as of the 1st March 2012. They say assistant accountant, so not the accountant himself. So definitely there will be a lot of issues. This is a financial position. Okay. This is a financial position. Let's go straight to the requirement. Prepare a revised income surplus account for the year ended. So in that section, they will ask us to prepare a revised income surplus account. Good. I'll actually work out this. Sorry. Now let's continue the questions. So prepare a revised income statement. So in that case, do this way. That is a revised income statement. Revised, that's the income surplus. Either we give the opening balance, if not, just pick the closing balance. So this is a redraft. A, don't forget the name of the company. So I've not seen the name. The name too. Okay, so let me just write the name here. Then revised what? The requirement becomes revised income surplus. Don't forget the reporting currency. That is all. Bring the balance, the closing balance given to you. Let it be the opening balance here. So you go straight to the first thing and look for the balance before you start to adjust. Okay. If you check, the income surplus balance is 483,000. That is what we have to invest. 483,000. They have already prepared a financial statement, and then you need to just adjust a few stuff. Because most often, the person that prepared the financial statement is inexperienced. So the treatment is not all that good, but you are the experienced, qualified accountant. You've assumed the position of what qualified accountant. So you can now give us the right treatment of the transaction. So let's see. When I do financial statement, the balance sheet is so easy. You just have to follow their approach. Solution to every question is a question itself. Just follow the format line by line. That is all. Some of the items will not change to be the same. Yes. That's a footnote. In course of an audit, you obtain the following additional information which has not been duly considered by the assistant accountant in drafting the financial statement. Note 1. The income statement has been charged with 16,000 being the first of 4 equal annual rental payments for an excavating plant. The first payment was made on 1st April 2011. Management of Sana Limited has advised that this is a finance lease. The plant had a cash price of 56,000 at the inception of the lease, which has an implicit interest rate of 10% per annum. Again, this question was set in the era of what? IAS 17, but it has not changed anything, so you can still stop it as it is. So first, find the present value. This is 4 years. Good. So now lease, the rental payment for lease according to IFRS 16, the rental payments are not an expense, it's not an expense. So you can't charge the income statement, so it's totally wrong. So the first thing you have to do is to reverse it immediately. So let's go to reverse it. So that example, rental charges, reversal of rental charges. So rental charges or the lease payments. Any of them you are free to go. Lease payments. 16,000. I'm reversing it. In fact, they have subtracted it from the profit, and the profit has been added here. So I'm adding back to reverse it. How do you get it? Yes, it has been treated as an expense. It is not an expense. That is all. Lease payments are not expense. So here, find the present value of the lease liability. The present value of the lease obligation. So PV of, that's the workings of lease obligation. Help me find this. This comes back to 10%. So 1 minus 1.1 to the power minus 4. 4 years. All divided by 0.1. 0.1. What is the discount factor of 4 solid years? So 10. So now, to solve this, the discount factor, annuity factor will be 3.170. So therefore, to get a present value, let's examine is this annuity factor times the payment, which is 16,000, which is equal to, so 3.170 times 16,000, that should give us the present value of the lease obligation. And that's the same as what? The cost. That's the same as the cost of the right of use, which is 50,072 or 720. Perfect. Now, not the cash price they've stated in there. Not what? The cash price. Look at this cash price, 56,000. Ignore. But in the era of IAS 17, you are going to use the cash price of 56,000. That is it. So take note, the slight changes in the calculation. So now, depreciation should be based on this figure. Your movement liability should be based on this figure. So from there, you can continue. Depreciation, come and then subtract. They've not depreciated it before, come and then subtract. Find your movement liability, and then find the non-current liability, find the current liability, that for that. Fine. This question, I will require a solution from you. Okay. So mean that you're going to try it and then get a solution. Let's continue. Okay, so now the fixed assets have been depreciated for the current year. Good. So no depreciation. So calculate all the depreciation and charge it in. The freehold property should be depreciated at what 2% on cost. On its cost of 630. So the cost is 630. Let's go to the draft balance. Sorry, the financial statement. So in this question, if you are solving this, that's the rough approach. This one, they give us financial statement, so it becomes rough, not right. Now let's go to the financial statement and the financial position. The balance is given to us. Now this figure you see here, freehold property. It's stated 630 here. 630. Good. They are telling us that it has not been what? Depreciated. So the cost is 630. Let's read plants and other. So plants other than lease plants is depreciated at what? 20% on reducing balance basis. So fine. So you don't even worry yourself. The amount stated there is the current value. So you just multiply 20% on amount stated there. You're fine. The lease plan is depreciated on straight line basis over the 4 years life of the lease. Don't let the examiner tell you how to depreciate a lease property. According to IFRS, it must be depreciated over the shorter of the lease term and the asset useful life. If they made only one available, 4 years, so it must be depreciated over 4-year period in it. And so, no 3. Investment property. The investment property is a freehold property carried at what? At its valuation on 31st March 2011. This last year's own. This last year's fair value. Fine. Its value as of 31st March 2012 has been assessed by a qualified professional independent surveyor at 62,000 cedis. So go and compare with investment property. So investment property is 75,000. That's the fair value at the start. But the fair value at the end is what? 62,000. So this is a fair value of loss. So there's a fair value loss of what? 75 and 62. Any difference? Fair value loss of 13,000. Fine. So come here, third examiner. Fair value loss on investment property. Open a bracket. Perform the work is throw the 30 in here because the loss subtract. That's free to go. And when you go, when I'm preparing the new financial statement, please just follow the approach. Just follow, unless the amount is not good enough. Freehold property after depreciation. But go and prepare your PPU by adding all these two together. Just these two for the PPE. Because you're not allowed to show the PPEs on the face like this. To pay the PPE. And the investment property, you're allowed to show it on the face on its own. So the investment property, now record the 62, not the 75 in your new balance sheet. It ends there. You are done. Let's continue the note. I've finished one. Don't worry, I've finished one. Now, the next one says that during the stock taken on 31st March 2004, an item had a cost of 30,000 were identified as either damaged or slow moving. It is estimated that they will realize only 20,000 in total, on which sales commission of 10% will be payable. So, find the NRV and compare it to the cost. Let's go. The cost is 30,000. The sales value is 20. Sales commission is 10. Let's calculate what? The NRV. IS2. According to IS2, inventory should be carried at what? The lower of cost and their net realizable value. So let's see something. The cost of the asset is 30,000. It is. Let's find the NRV. NRV. Selling value or the sales price is 20,000. Less commission. Sales commission is 10%. Calculate 10% on the 20,000. You get 2,000. Take it off. Let me worth 18,000. So NRV is worth 18,000. Now, if the NRV happens to be the least one, then that means the inventory should be written down by. So inventory written down by the difference. So the difference between 30,000 and 18, that would be 12,000. It's an expense. Go and increase it. Add it to your expenses, meaning that we have to subtract it from the cumulative profit here. So this one, subtract from your profit. Again, when you go to the new balance sheet you're going to prepare, can you use the NRV as the inventory figure, not the one they stated there? That's all. Or if they have a lot of inventory, more than this 30, the inventory they have is more than the 30, then subtract this. This becomes two treatments. Number one, charge it to your profit, subtract it from the profit. Number two, subtract it from the inventory. So let's check for this particular question. And when I check this particular question, when I go on the page there, I have 302. That means they have more than, it's not the only, like this slow moving, it's not the only inventory they have other inventory. So I cannot come and record 18,000 instead of this 302. So in short, and I've been that way. Sorry, third examiner. Subtract this 12,000, the entire inventory needs to be what? Written down by 12,000. That is all. So subtract this 12,000 from the entire inventory because this slow moving is within the entire inventory. So subtract the 12 million from the entire inventory. That is the second leg. The first leg, subtract this one from your profit. It's an expense to you. The inventory probably I'm part of it down, so it's an expense. That's all. So if I should end here, it means that I write here inventory written down by 12,000. I'll subtract. Examiner, this is my workings. Refer the examiner to the workings. Good. When I go to the balance sheet, you have the PPE, you are not inventory. The balance sheet to kindly pick this 302,000 less 12,000. So I don't pay, I'll get 290,000. That is all. You are done. That is redraft. But redraft questions are so nice than the main question because about 40% of the work has been done already. What level is just adjusting? Because they provided the format alone, they provided the format for you. Format is still here. All the formats. Good. Let's move on to the next one. Note 5. An impact of material delivery on 12 March 2012 for 2,500 has been discovered. It has not been recorded. It has not been recorded, though the material were included in the stock count. So what the accounting treatment? An invoice material delivered on 2012 March 2012 for 2,500. So materials was delivered. Good. Material delivered. So meaning that they have received some goods and then the invoice has not been included in the entire. Meaning that the invoice is missing. Once the invoice is missing, there's no sub-document. That means it will not be captured in the above financial statement. So we have to capture it. That's all. And that one, it just calls for two treatments. So 2,500. So one, what do you do? So this is material. What will be the accounting treatment for this particular? It has been included in the stock count. So don't go and add it to the inventory. They've added already. They've added it to the inventory already. So it's part of the closing inventory. It's part of the closing inventory. They both be counted into. So don't go and add it to closing inventory. So the treatment will be, have you paid for it? No, it's not paid for it. So add to your payable. That's the first. Second, it's an expense. Materials are direct cost, they are direct expense. That's why we add open inventory plus purchases. Purchases is an expense. That is all. So this is an expense to the company. Current year, any amount of goods that you buy in the current year is an expense to you. That's why we add it to purchases. So if this is an expense, which is a direct expense, which has not been captured because the invoice was missing, they've now discovered it. So that means let's treat it. So first, it's an expense. So material 2,500. I'll subtract and go to that of the financial position. Why you show yourself? And go to trade payables or trade creditors. I will increase it by 2,500 because some paid it. If they paid, I will subtract from the cash or the bank balance. That is all. They are owing. They receive the goods, but it has not been accounted for, meaning that they've not even paid it for. If they pay, I'll take it off from that of the bank. I saw. Let's note. Sun Unlimited operates some heavy excavating plants, which requires a major overhaul every 3 years. The overhaul is estimated to cost 90,000 and is due to be carried out in April 2013. The year in question is 2012. Okay, fine. The provision of 60,000 represents two annual amounts of 30,000 made in the years 2011 and 2012. Let's go to the financial statement. Provision for plant overhaul 60,000. It's gain 60,000 here. Let's see how best we can do it. Overall, this is IAS 16 and IAS 37. The overall is estimated to cost 90,000 and it is due to be carried out April 2013. The provision for 60,000 represents two annual amounts, okay, of 30,000 made in the year 2011-2012. So they've made a provision of 30,000 in 2011 and 30,000 in the current year. Good. Towards the 90,000. Now, the item that they need is what? 90. Sorry, the amount that they need is 90. They don't need 60. The total cost of the overhaul is 90, not 60. So that means they shall make sure that their provision is up to 90, not the 60. So they need to top it up. So in short, additional 30,000 need to be raised to top up the 60,000. The 60,000 is in the financial statement. So far, they've only raised 60,000 towards 90,000 expenditure, which is not enough. It is not enough. So what do we do? Immediately raise 30,000 addition to it, so that in the new balance sheet, the provision for plant overhaul should be worth 90,000, and then add 30,000 to your expenses. That is all. This provision, the additional provision of 30,000 is an expense. So let's go. I'll come here and tell the examiner. Additional provision 30,000. Don't forget to add it to the 60,000 to get a 90. That is all. In fact, we are subtracting because it's an expense. Movements in provisions are expense. Good. How do we get it? This is redraft. Let's go to note 7. The deferred tax provision required as of 31st March 2012 has been calculated to what? 112,500. It tells me that they've not made any provision for deferred tax, and if they have, it's the open balance. Let's go and check. Deferred tax. I can see deferred tax here. I said that is the open balance. First April 2011. But they've given the closing balance in a footnote. So the closing balance happened to be what? 104,500. Let's go to the board. Anytime we are calculating for deferred tax, we compare only two items. Let's do it here. Deferred tax. Just compare the open balance, which was the 94,000 stated in the trial balance, in the financial position. Leave a space and write the closing balance here, 112,500. And the difference is sent to the P&L. That is all. So basically, compare the open balance. This is the balance carried down, and this is the balance brought down. The difference between this and this. So in short, don't need to worry, open a lot of accounts. Redraft that one asks a lot of calculation. Just write provision for deferred tax. Open a bracket. It has increased, right? Increase means it's an additional expense. 112,500. Let the open balance of 94,000. Okay, so if I should do this calculation work, 6,000 plus, so that's 8,500. It's an expense. Subtract it. If you go to the new balance sheet, you can record 112,500 in there. That is all. Second, let's see the last footnote. The 70,000 loan note was issued at par on 1st April 2011. I like this question. 1st April 2011, meaning the beginning of the financial year. And redeemable after 3 years at a premium of 4,724. That gives giving an effective interest rate of 12% per annum. Interest is paid in arrears. At the 1st March, the accountant charged interest at 10%, which is 7,000 to the income statement. This 7,000 is totally not true because with respect to IFRS 9 or IAS 39, it states that all financial liability should be stated as what amortized cost, except otherwise stated. Fine. So amortized cost simple means we should use the effective interest rate, which is the 12%, to calculate the final charge, not the nominal interest rate of 10%, not at all. So what do we do? So first of all, let's use the 12% to calculate. Let's do something here. So first, how is the 12% to calculate? So 70,000, let's see something. Effective interest rate. Effective interest rate. The effective interest rate is 12%, right? Let's use that one to do the calculation. Average. So 12% times 70,000. That is give us something like that should be 14,000 or 8,400, right? That should be 8,400. 8,400. The nominal interest rate happens to be what? 7,000. They've calculated already. So now they've already charged the nominal rate, which is 7,000, which is totally not true. So that means we have to charge the extra. But the finance cost. This finance cost is the difference between the effective and what? The nominal. Now what happens is this. With the nominal interest rate, if we calculate it, so at that exam 8,400 less than 7,000, finally add, subtract 1,400 here. Now we get it. That is how we look at it. This answer is called the difference. We call it amortized cost. This is what we mean by what? Amortized cost. That is all. Now, in your financial position, add this amortized cost to that of add it to that of the 70,000, and then you put it in. So in the new financial position balance sheet, you don't need to provide this as what 70,000. It must be 71,400. That is all. That is all. Now, I've been saying not all items change. Some of the items are still intact. Let me tell you about 5 items that probably does not require any changes. They are intact. 5 items. Let me start. So if you go there's a redraft, at least some of the items will not change. Number 1, trade receivable and prepayments did not change. So they are intact. Number 1. Number 2, bank 69,000 never changed. So 2. Number 3, stated capital never changed. Number 4, capital surplus never changed. Item number 5 that did not change is calculation. So if you copy this everything for the examiner back as a solution, which is an ISO, you get 5 ticks free of charge, 5 solid ticks. And those that you can change, that's all. It's balanced nicely for you. That is the redraft. Okay. Now, on that note, you have to prepare on this and prepare the financial statement, the balance sheet for us. It's just like with depreciation and the finance cost on the list. That is all. We're done with this particular item. So kindly complete the depreciation and then the finance cost on list. Bring it in and we're done with this. And bring it back to the financial position. Kindly prepare it. Let me please come through this and we are moving on. Now, let's look at this. This is more recent. This is November 2017 ICAG question number 3. Let's see something. This question is about Okushi. Okushi Limited is a listed cattle manufacturing company. Prepare this draft statement of financial position as at 31st October 2017. Now, 31st October 2017, how the year start from? The next day, don't forget the room. When you get it, the next day, the previous year. So 31st October, the next day, what? 1st November of the previous year, that's 2016. So 1st November 2016, that's the year where the year starts from. Good. On subsequent examination of the books and records, the finance director prepared a list of issues which he believes may require amendment to the draft statement presented. This is the financial position for Okushi. As usual, not all these items will have issues. Not at all. Some are correct. So those that did not mention, I'm feel free and write them in. So here, I'll put the requirement first. Check to show you any question required to the profits and other comprehensive income for the year. To extract the statement of financial position as of 31st October 2017, taking the above into account. Now, watch here. Look at this. Let's go to the financial position and look at them in. Retained earning, they've given you the profit for the year. Once they've given you the profit for the year, then it means that you can do what you call other comprehensive income. And this examiner is very, very smart. He asks you other comprehensive income. Like from the previous question that we saw, I explained to you that anywhere you see other comprehensive income, that means there might be revaluation in that person. There might be revaluation. So in this particular question, I'll provide a pro forma for you, and I'm going to work on it for me. I'm going to work on it for me. I will not solve, no. I'll provide a pro forma for you. So that examiner, revised profit, loss, and other comprehensive income. So A, the name of the company, revised profit and loss, and what? OCI, other comprehensive income. That's in the heading for the year ending. Start with your currency. That examiner reported or drafted profit after tax. So that examiner profit after tax drafted. Pick it from the question and start amending that profit. Let's go and pick that one quickly. And listen, when you start the question, the first 15 marks, pick them. Profit for the year is 95,000. So you write this 95,000, you score yourself 4 solid ticks. 4 ticks. One for the name correctly, heading correctly, currency, and this. I have not started anything though, right from the requirement. That is how I solve my question though. Right from the requirement, you start ending ticks. Yes, right from the requirement. Profit after tax or profit for the year. Maybe if I want to follow the question. But I wrote it before I went for it. Okay. So profit for the year 95,000. Then all the adjustment follows in that order. All the adjustment follows in that order. That's cool. My interest is the adjustment. That's where my issue is. Note 1. The following notes are relevant. PP are carried after charging depreciation for the year. They charge depreciation. That means we can't get anything to do. Oh, this is not to this. I've leave the depreciation fund to charge you. No, we should have charged the depreciation. That means we won't get anywhere. That is why the revaluation, the revaluation. Okay, let's see. On 31st October 2017, where 31st October, that's the ending date, that's the last day of the year. A piece of property carried at 130 million was revalued at 110. This revaluation took place at when? At the end, according to the time. And the 130 is the carrying value. So 130 is what? The carrying value. And then the revalued amount is what? 110 million. Fine. The revaluation has not been accounted for. Perfect. So here was the revaluation. Immediately, capital revaluation gain or loss for me. Immediately. The carrying value is 130 million. The revalued amount is 110. So therefore, there's a revaluation loss of what? 20 million. What is the accounting treatment? The accounting treatment, the revaluation loss enters the P&L as operating expenses, except for the previous gain. Let's do something. The revaluation reserve included with the other components of equity had a balance of 12 million due to the previous revaluation of this property. I like this examiner. He was testing on the reverse. He was testing on the excess. He was testing on the excess or the exception. Now it means that there is a revaluation loss currently of what? 20 million However, the same property, this property, produced a revaluation gain previously, which is 12 million. How do you treat this? But I like this section of the notes. It's very straightforward, but very important. So first, wherever this revaluation gain is a section, you have to go there and then reverse it. So what you do is, the problem is inside or is included in the other component of equity. It's inside this figure, other component of equity and other comprehensive income for the year. So it's in the other component of equity. And they told us, so I'll come and reverse it from this figure. I will come and reverse it from that figure, other component of equity. If they should have informed us in other comprehensive income or they didn't tell me anything, I will reverse it in there. OCI. That is all. So in short, if 20 million is the loss and 12 million, they are reversing with the other component of equity, 11 what? 8 million. So now the actual loss that should hit the P&L should be what? 8 million. So in our P&L, we place 8 million there. So let's go and put 8 million. So after the examiner, revaluation loss 8 million. Even though the loss is what 20, there's a previous gain of 12, which I netted off. I'm done. In a new financial position, please and please again, kindly subtract it from the other component. The examiner told me specific list. It is included with the other component of equity, specific. Other component of equity. So come and subtract from this 120,000, it ends there, you are done. Do not hit it against the 35,000 because the picture is in 35,000. That's all. Let's move on. So, okay, second part. A sale agreement was entered into during October 2017 to sell some of the plant. The plant sold had a carrying value of 45 million at the date of sale. It was sold for an agreed price of 39 million. No cash as yet to be received in respect of this sale. As a 30-day credit period was agreed with the purchaser, no entry has been made to record this. Good. So this immediately, someone is owing us. We sold an asset for an agreed price of 39 million. So if you receive the proceeds immediately, add the proceeds to your receivable. So go and add it to your receivable because someone is owing us. So go to the current trade receivable, trade and call it account receivable or other receivable and add it to it and call it account receivable or treat on its own. Or in short, add it to your current asset, the 39,000. Wait, let's continue. Because you show some asset, well, you don't receive the money. Second, find the profit or loss on disposal. The asset carrying value is 45. You sold it for 39. So there's a loss of what? Loss of 6 Ghana million. So 6 Ghana million cities, right? Because there's a loss of 6 million. That 6 million immediately report it. So come here, loss on disposal 6,000. So I've been saying that Redraft is one of the interesting questions ever. It's one of the interesting. That's not require huge calculation. They've done everything for you. Just little issues. That's all. Second, the most important part, they say they've not done anything So when you sell assets, there are three steps that we did under IAS 16. If you have not remembered that, kindly pick it up. Under IAS 16, if you sell assets, there are three steps that I gave out. First, check records of the proceeds. This proceeds we have added to the receivable under current asset. Fine. Step 2, calculate the profit or loss from disposal. We've done it, we had a loss. Fine. Step 3, I normally call it remover or remover. Remove the details of the disposed asset from the pool. So cost from cost, accumulated deviation from accumulated deviation, or finally current amount from where? Current amount. So in this particular question, just the current value is 45. So that means your PP should go down by 45. That is all. So your PP, make sure that 45 goes straight. So the final answer for PP here, that 1020, if you take off 45, you can take off 45 from it, and then take the loss, the revaluation loss also from it. There's a revaluation loss of 20 million. So this BP, we are subtracting two items from it. First of all, the revaluation loss, we are subtracting 20 million from this, so 20,000. Second, the disposal, that is all for the BP. That is all for the BP. And this is so interesting. Only two figures are subtracting from this. Only two figures, and that's the final answer. Let's continue with the sign. So expect redraft. When I check the terrain, May 2012, and then 2017 November. So for 4 years, right? 2021, have to do as a river. Note 2. The equity investment had a fair value of 380 million as at October 31st, 2017, which has not been incorporated into the financial statement. The company has taken a decision to take all fair value gains or loss on equity investment where other comprehensive income as permitted by the IFRS. I like this one. That means this particular equity investment is for held for sale. That's the meaning. Held for sale with fair value through what? OCI. Please have not gone through the financial instrument. All of them, the videos are available. Can you go through and then update yourself on all this? So first, check whether there's a fair value gain or loss. So check whether there's a fair value gain. Let's see instruments. Equity investment is 360. But the fair value reporting date is what? 380. So first there's a gain of what? 20 million. How do you record the gain? Let's go to the board. Don't bring the gain here. Wait, when you are done, or it's like, don't even bring it inside at all. When you're done with everything, this cost after tax, the right OCI section. The question, there's OCI in the question, which is 35,000, right? Then you say fair value gain on equity investment, 20,000. That's all. So if I should end here, my fair value gain is to be 55,000. I should end here. Now let's go. So that means second, come in, change this one to what? 380,000. You are done. It ends there. So that means this OCI that you see here will no longer be 35 to be what? 55. If I should end here. Perfect one. The other one let's go to the 3. The 5% debenture was issued on 1st November 2016 for a cash proceed of what? 150 million. And was correctly recorded. Fine. The redemption terms of this debenture are such that the effective rate of interest to maturity was 6.5%. The only other entry made in respect of the debenture was the payment of the 7.5 interest on the due date. And that means they have to carry that what amortized costs. That's all. So the only other entry, so they pay the interest, and once the interest is taken into account. So this question is the same as the one that we just went through. It's the same as the last footnote here, where I showed us and this one. If we take into account of the 7,000, wrapping up with the game. So that particular footnote is actually the same as if the 7,000, if you call it 7,000, the same thing in here. So the 7.5 million interest on the linkage has been recorded. So it means that you have to find the effective interest rate, which are the 6.5% times the 150, and find the difference between that one and this, and then put it in, pop it up on the place. If you check the current liability, did you see interest in there? It has been taken into account, so that is all. It has been recorded correctly. So take notes of that particular note. We are done with this note. The finance cost on it. Note 4. Note 4. Okushi Limited offers a 12-month warranty on all goods sold to retail customers. A provision is maintained for the expected cost of handling this warranty. These have not been updated as of 31st October 2017. Good. Now, Okushi sold 40,000 units of its relevant product during the year. 40,000 of the goods. Okay. Now, all of which qualify for warranty, that's fine. It is expected that 10% of these will need minor repairs at an average cost of 500 each. 3% will need major repairs at a cost of 10,000 each. All costs expected to be incurred within 12 months. Fine. It means that it qualifies to be what? A provision. So let's calculate the current provision. Just multiply the percentage attached to them, that is all. So 10% of this need minor. So 10% times 500. Okay, so that will be 500 each. Then 10,000 each. Okay. And it made it so for 40,000, right? So average cost of 500. So just multiply 500 by 40,000. And 3%, that is 10% on it. That's all. And then the major one, you find 10,000 on the 40,000, then you find the difference on that. Okay. So basically, let's be wrapping up. Let me just do this, perform this calculation for you to end the game. As we are ending here, please and please again, you are not done. You need to provide me with a solution of that. These two questions. The first, third examiner, units. The units. So the units will be like this. So the examiner units, the work is units, units, and then the unit cost, repair cost, so repair cost to that. Good. Then all what we have to do is this. We have to tell the examiner minor and major. Minor and major repairs. The total units is 10,000. Then with the major account for 3%, minor account for 10%. That is all. So just find the percentage. So just find 10% of these goods. So 10% of 40,000. So 10% of 40,000 should give us 4,000. Perfect. The minor is 3%. So 3% of 40,000. But 3% of 40,000, my calculator is saying is 300, right? So it should be 1,200. Good. Should be 1,200. Then finally, what is the repair cost? To conduct a major repair, it is 500 Ghana cedis. And to conduct a minor repair, it's 10,000 cedis. So finally, you multiply. So 4,000 by 500, that should be around. Any answer for me, friends online, as we are ending the game? Any answer for me, friends online? So 4,000 by 500. Any answer for me as we are ending the game here and continue again? Okay, so that should give us 20. So finally, we have 200 millions. Let's write millions here. So that's 200 million. And then that of this that should give us something like 12. That should give us something like 1,200 times 10,000. So I can get 1, 2, so that's 12 million, right? 12 million. Can you confirm for this for me? This one is 200 million. The 4,000 times 4,000 times 4,000 times 200. 4,000 times 500. So 4,000. It should be 2 million. Should be 2 million. Let me compare. 4,000 times 500. That should be 3 here, 3 here. Okay, so it should be 2 million. Try to find it. 2 million. That is all. Yeah, then put the total cost together. That would be 14 million. So that is the provision. Compare this one to the opening balance, and that's the end of the game. Compare this to the opening balance. When the opening balance, go to the question and get opening balance in the warranty provision. That is 12 million. The opening balance is 12 million. This is 12,000, but we should be 3 zeros there. So that means it has increased by 2 million, and that 2 million should hit the P&L. So this provision should be worth 14,000. I don't know, they should be 14,000. And don't forget to subtract the 3,000. Again, some of these figures did not change. Final dividend, no notes, corporate tax, no footnotes. Dividend declared here, nothing will change. Your final profit after tax, your final adjustment figure, come and replace it by this, and that's the end of the game. Good. Cash and bank never change. Inventory never change. Intangible asset never change. So no matter what, you have a lot of free marks to pick. So on that note, we will end here. This is how far the good Lord will bring us. On that note, we will continue again 1 minute. Kindly subscribe if you have not done that. Then share the link with your friends. If you don't have any question, kindly ask before we close the chapter of the game. Good. Now, I'll leave you with 2 trial questions. Kindly try them for me. We are trying the one that we just analyzed. Kindly balance it and report it to me. Again, there's a particular question in here that I want you to do for me. We call it FAFA Limited. FAFA Limited. It's a question that I like the question. I really like the question. When I ask the question, yes, this is FAFA. So that's question. Can you try that one? This part also. Can you try? Yes, this is FAFA Limited. FAFA. There is a question number 19. I need a solution within 24, sorry, 48 hours. Can you put in the solution? Go through all the footnotes for me, solve them, all the footnotes, all in your material. Requirements here, that's May 2019. Good. I may solve this question on YouTube Live between the date of 6th and 7th of April in the evening. So kindly take note of this. I may solve this question with you. Try that one. This has been solved already. This video. So I'll go through. Okay, so on that note, have a nice evening. I'll meet you again when I see you. Goodbye. Have a nice day.